Hey there, savvy investors, and welcome back to the channel. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and short squeeze dynamics, focusing on a unique microcap company that's recently caught our attention, Global Interactive Technologies, Inc., or GITS. This isn't just a theoretical discussion, we're going to break down the actual numbers and what they could mean. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/sector info. Let's get acquainted with GITS. Global Interactive Technologies, Inc., through its subsidiary, operates as a technology-focused platform company primarily out of South Korea. They're in the communication services sector, specifically internet content and information, and they're behind Feigning, a digital fan engagement platform designed to support online communities, content discovery, and user interaction. With a modest market cap of just $7.06 million, GITS is firmly in microcap territory, making it an interesting player to watch. Show price chart. Looking at the recent price action for GITS today, it saw a 0.96% change. Over the last 5 trading days, it's down -9.25%, but zoom out to the last 30 days, and GITS is up a respectable plus 15.8%. Today's volume sits at 26,100 shares, which is remarkably low considering its 30-day average volume of 1,405,093 shares. In fact, relative volume today is Xerox average, meaning current trading activity is extremely quiet compared to its usual pace. What is cost to borrow and why it matters? So, what exactly is cost to borrow and why should you care? When someone wants to short a stock, meaning they bet its price will go down, they first have to borrow shares from an existing owner. Just like renting a car, there's a fee involved. This is the cost to borrow, or CTB. It's an annualized interest rate the short sellers pay on the value of the shares they've borrowed. If a stock is in high demand to short, or if there are very few shares available to borrow, that fee can skyrocket. And yes, it can easily exceed 100% annually, sometimes even reaching hundreds of thousands of percent, because the supply and demand for those borrowable shares are so intense. For short sellers, CTB is a direct cost eroding their potential profits, and a high CTB indicates significant pressure on those betting against the stock. Why this stock is hard to borrow right now. Highlight CTB numbers on screen. This brings us directly to GITS. Our hard-to-borrow screener reflects Global Interactive Technologies, Inc. for a very specific reason. Its annualized cost to borrow fee currently stands at an astounding 939.4%. Let that sink in for a moment. While the CTB momentum has seen a slight dip of -2 percentage points over the last 5 trading days, this figure remains exceptionally high, indicating extreme demand for GITS shares from short sellers. But here's the kicker, there are currently only 300 shares available to borrow. Yes, you heard that right, just 300 shares. When you compare that to GITS' estimated float of 2.4 million shares, you can see why this stock is considered extremely hard to borrow right now. Low availability and high demand naturally drive up the price to rent those shares. Squeeze mechanics explained. So, what happens when a stock becomes hard to borrow with such a high CTB? This is where the short squeeze mechanics come into play. A short squeeze occurs when the price of a shorted stock unexpectedly rises, forcing short sellers to buy back shares to limit their losses. This buying action further pushes the price up, creating a snowball effect. With a CTB of 939.4% and only 300 shares of GITS available, the pressure on existing short positions is immense. Any significant upward price movement, especially on increased volume, could force those short sellers to cover their positions, essentially buying back shares at higher prices. Our internal composite squeeze score for GITS is 47.2 out of 100, indicating that while several factors are aligning, it's not a guaranteed squeeze setup. It's crucial to understand that a high cost to borrow, while an indicator of pressure, does not guarantee a squeeze. It can also mean that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their short positions. Dilution risk check. One critical factor to consider when evaluating any potential short squeeze candidate is dilution risk. Dilution happens when a company issues new shares, which increases the total number of outstanding shares and can decrease the value of existing shares, effectively working against any upward price momentum. Even with a high cost to borrow, significant dilution can completely offset or negate a short squeeze thesis. For GITS, we've conducted our dilution risk check and found no recent diluted SEC filings such as -1, -3, or 424B within the last 90 days. Additionally, there's no recent reverse split found for GITS in our look-back window. This absence of recent dilutive activities is a positive sign for the squeeze potential, as it means fewer new shares are likely to hit the market and suppress the price. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, for GITS, what should you be watching if you're interested in this situation? First, keep an eye on that astronomically high cost to borrow rate of 939.4%. Second, monitor the shares available to borrow with only 300 available. Any slight increase in demand could further constrict supply and put more pressure on shorts. Given today's extremely low relative volume of Xerox average, a sudden surge in trading activity could be a key indicator. Look for a significant increase in daily volume, ideally accompanied by strong upward price action, which would challenge those short positions. The low float of 2.4 million shares means it wouldn't take a massive influx of capital to significantly move the price if shorts are indeed forced to cover. Global Interactive Technologies, Inc. presents a compelling case study in hard-to-borrow dynamics with its nearly 940% cost-to-borrow fee and a scarcity of just 300 shares available to short. While its 47.2 composite squeeze score suggests potential, it's critical to remember that these situations are highly speculative and carry significant risk. As always, this is for educational purposes only and not investment advice. If you found this deep dive into GITS informative, please smash that like button, subscribe for more unique stock analyses, and let us know in the comments below what other stocks you'd like us to feature. Thanks for watching, and we'll see you in the next video.